Welcome back. I'm Jeremy Szafron. The precious metals market is giving us a masterclass in volatility. Now, after a powerful 9-week rally, gold has pulled back and taken a breath here from its peak of near $4,400 an ounce. Now, let's frame this move with proper context, though. Despite the recent drop, gold does remain up more than 50% year to date, a performance that far outpaces most other asset classes. So the dominant question isn't one of panic, but it seems of strategy. Is this a much-needed consolidation within a powerful bull market, or is it a warning that the trend is exhausted? Now, this is all unfolding as the Federal Reserve kicks off its two-day policy meeting today, with markets overwhelmingly pricing in another 25 basis point rate cut tomorrow. Now, while many were caught off guard by this reversal, our guest today was watching for something far more specific. Now, last week, our very own Gary Wagner of the goldforecast.com released a video identifying a rare confluence of technical signals, a specific candlestick pattern combined with a powerful trend anticipatory formula from legendary analyst Tom DeMark to call this top with remarkable precision. Now, he saw the exhaustion point before the reversal happened. We're going to play that exact clip for you right now.
Traders, we have a very interesting pattern, and the pattern that I'm talking about was created by Thomas DeMark, called a sequential 9. A total of 9 green candles completes a sequential 9. So what does that mean? Well, according to Thomas DeMark, the core function of the TDS9 is to help us identify trading opportunities by buying potential bottoms and selling potential tops. When a rising 9-candle pattern emerges, you may have a downside reversal, indicating that you might need to trim positions or make sure that you're either on the short side or neutral. We could truly be seeing gold at a top here.
Coverage you get over at his goldforecast.com, the premium package, I think. Let's bring in Gary Wagner now, joining us from Hawaii to break this all down. 9 consecutive candle tops. Hey, my friend, good to see you.
Good to see you also. Yeah, that was released on Friday to our premium members. They get 5 videos a week. And for those that like to hear me and would like a more comprehensive idea of what I'm doing on a daily basis, they just go to thegoldforecast.com and sign up and try it out. But as far as the candlestick pattern that we recognize, it is the first occasion since 2013 that on a weekly chart, you get 9 consecutive candles, and it is an exhaustion signal. On top of that, that red candle created a simple candlestick pattern called a dark cloud cover. And so the combination of both of those, to me, gave a high probability of possible sell-off and corrections, the foreboding of extreme positivity or bullish market sentiment moving to bearish.
Okay, that's interesting. I mean, it's the kind of granular analysis our audience appreciates. So, okay, you identified the exhaustion. Now let's dissect the aftermath, I guess, Gary. I mean, in your Kitco column on October 23rd, you noted a doji candlestick pattern, right, which typically signals market indecision after a major move. Since then, however, the selling has continued. We've broken below that $4,000 level. How do you read the price action of the last few days? I mean, has the subsequent selling invalidated that doji signal? Are you seeing this as just noisy? What are your thoughts?
I think it actually validated it. We'll look at a daily chart, and when we do, you'll see that there are 3 candlesticks beginning on Wednesday, the 22nd, Thursday, the 23rd, and Friday. And the size of particularly Fridays and Wednesdays, the article was the 23rd, it was looking at this candle, spell a potential reversal or consolidation in which a big move could be coming. And that's exactly what we saw, because on Monday we saw a drawdown of $124. I mean, realize this rally from the beginning at 33.50 up to call it $4,400 an ounce was ridiculous. Currently, this correction has given back about 10.5%. I believe there's a high possibility it could go a little lower. I was hoping to find support at the 38.2%. That would be a real shallow correction, but realized that when we got a signal from a weekly chart, it would give you different numbers altogether. So my sense is that if it does continue lower, 38.72, that is just a 50% retracement. And you see that a lot in stocks. They move up $2, they come back and correct $1. Mm-hmm. The big one for a deep correction is a 61.8% correction, and that would take gold to 37.48. But traders, here's the good news. For those that know my technical studies that we use, this rally, in terms of an Elliot wave count, this is all wave one. And we are now, I believe, in a wave two scenario. And when that ends, and it will, I'm still really bullish on gold. When that ends, whether it finds support here, which is less likely, or around 38.70, 37.48, in other words, wherever it ends, then we're going to start a third wave, primary third wave. These are primary waves. And a primary third wave, by its definition, is never the shortest of the impulse waves, which means it could have this kind of move again. One thing we do know is if we do get a third wave, as I believe we will break 4,400 again and head to new areas that we have never seen before. 45, 46. It's just exciting. And my idea about this correction is it's been long overdue. Yeah. I mean, look, we've never seen, we have seen, but very, very infrequently, this kind of move from 33 to 43 is $1,000. And then it goes above that by a little bit. So $1,000 rally is not what we're used to. And that's what this was. When you consider I marked the beginning at 33.48 and it trades to 39.95, that is a huge move. And because of that, that's why I think this correction could continue to go on. But realize that ultimately, this market is based on fundamental drivers. So rate cut, that's bullish. A successful trade talk with the president of China and Trump, that will affect the market. That will not be bullish because that tends to bring gold down. But we have a government shutdown in the United States. That's at with 27 days, and they stopped issuing food stamps and food for those unfortunate enough to not be able to afford it. How is that going to affect gold? Mm-hmm. The drivers that have been driving gold, I believe, will continue to be present in the market. And after this correction is over, we will go to a new level we have not seen before. That's my take.
Yeah, interesting. Okay, so take a little bit of a dip, of course. I mean, it could take us to that $3,800 mark. I mean, is that the new kind of floor? I mean, we were talking about 4,000 for a while, but you saw it kind of come back and bounce back each time that these sell-offs happen. Is there a new base that's kind of discovered there? Is it 3,800?
Well, the reason I'm picking 3870, so just below 39, is that's what the charts are telling me, because the first number you want to look for in a correction is the 23.6, 4,100. Blast through that. Then, well, will it find support at 39.97? It opens there today and trades below it. It's come up pretty interestingly enough from the low of the day. So that's telling me that they're either squaring off positions if they're short. I don't know. But it broke through this one. So the next logical point to look at is 38.74. Mm-hmm. That's what we want to see. If gold trades lower, how it reacts at these various points. Because using Fibonacci method has been very successful in pre-predicting price corrections.
Yeah, well said. And it was nice to see you ahead of the game there. I mean, it was a good call. You and I were chatting, and it was nice to just have you back today. I don't know if you have a chart there, Gary, but if we bring silver into the conversation just briefly, because it was a market leader on the way up with talk of a genuine physical squeeze driving its outperformance. But during this correction, I mean, it was underperforming gold significantly, with the gold ratio widening back outwards towards about 35-1. In your view, I mean, is silver's more severe pullback kind of a warning sign for the health of the entire precious metals complex, or with that ratio at this level, do you see silver just simply reverting to its volatile nature that we always talk about?
Well, listen, silver tends to outperform on the upside when gold and silver are moving higher, and overperform on the downside during a correction. That's what we didn't see. Silver's been really almost head-to-head in terms of percentage gains through the rally. Now, this rally here, as you can see, I'm putting from July with silver at 36.30 and the top at 54.51. And when we look at it, I don't know why, but I should, let me add this. That doesn't matter. Yeah, we'll put it in. You can see it broke through the 23.6 like a butter knife. Look at the size of this move. You got the same kind of dojis or small body candles last week on the same date, and then you had a significant drop as we did in gold yesterday. But look at today's candle. It's actually a small body candle with a long lower wick, which could become what's called an umbrella line or a hammer. The same with gold, but it's green. It's actually above its opening price. So silver wants to run.
Yeah.
It has been behind gold. Gold was making, I don't even know how many all-time new price highs over the last year. I mean, it's a huge number, a double-digit number, but silver wasn't. But finally, silver broke above $50, and that would have occurred on Monday, the 13th of October.
Right. Yeah.
Ran as high as 54, and now it's correcting. And if you look, this low is kind of near the 50% retracement. That's a possibility of finding support there. Again, that would have if there's a positive move forward in the trade negotiations between China and the U.S., silver will respond in a very bullish manner because it's such a highly used industrial metal. And so that's one possibility as to why we're seeing a differential today between gold and silver. The exciting part is also I'm labeling this as a primary one. This is a primary second, meaning when the correction is over, I expect silver to take out 54.40 and absolutely go to 55, 56 and beyond. My son, who's an excellent technical analyst, for months has been calling for $60 silver, and I'm going to take his call because he's really good at what I do. Yeah, he's watched me do everything for 8 to 10 years, soaked it in, and now he does it himself. And he loves silver. He made the call for $60. I'm proud of him, and I absolutely believe that that's where we'll see silver go to.
Well said, Gary, and say hi to Joey for us here. We know he's always helping you behind the scenes too, and we appreciate him. Okay, obviously your analysis is always grounded in the charts, but there is those kind of powerful external forces that are reacting. I mean, obviously this week we have two opposing narratives. We got tomorrow's FOMC is certain almost to cut rates by 25 basis points, a dovish move that's typically kind of tailwind for gold. And then we got this primary catalyst from this very correction is this optimism over the U.S.-China trade deal, which is reducing the near-term safe haven demand. It kind of looks like, and from a purely technical perspective, I mean, which of these two fundamental forces, a dovish Fed or geopolitical de-risking, is exerting more influence on your charts right now?
Actually, I'm not I use charts as a primary tool, but I call myself a hybrid analyst in that chart numbers do not move the market as much as we want them to. They show you possibilities, but fundamentals control price action in the market. So we want to look at the fundamentals first and get a sense as to how those fundamentals could affect gold or silver or soybeans if the deal goes through where China starts buying our soybeans. Those are the fundamental things that will make these markets move great. And an announcement that Trump managed to get a order for a lot of soybeans is going to make soybeans go up tremendously. Has not a thing in the world to do with the chart. Mm-hmm. So I always believe fundamentals are the core reason a market moves, but there's so much noise in figuring it out. Charts are easier to read. That's what got me into being a hybrid trader, is that I would hear a lot of the fundamental news and they could contradict each other. Then I became uncertain as to what's going to be the primary catalyst. Yeah. And I looked at a chart. Oh, it's clear. So, yeah, fundamentals move the market, but analysis of charts combined with that, I believe, is probably the best way to analyze markets.
Yeah, I got to ask you on that point. I mean, let's game plan a scenario, because I mean, you and I've done this throughout the year, and there is sometimes a tweet or whatever, all things are out the window. We kind of start fresh. If Chair Powell comes out tomorrow and delivers a surprisingly dovish message, perhaps signaling a more aggressive cutting cycle into 2026 than even the market expects, could a fundamental shock of that kind of magnitude override the current bearish technical momentum and spark an immediate reversal? Or does the chart damage that we've seen require a period of consolidation and kind of base building regardless of the news?
It's a very, very good point. I mean, first of all, the market, the precious metals, have priced in a 25 basis point rate cut tomorrow. They've also suggested the high probability of continued rate cuts through the rest of the year into next year. Very, very dovish. Mm-hmm. He could come out and be very dovish. I expect Powell to walk a tightrope. In other words, he'll announce a rate cut. He might suggest continuing rate cuts, and then he'll talk about the factors that he's concerned about in the economy, which is the government shutdown, which is all of the things that are going to have a negative influence on our economy. And that actually, I believe, will make his take more dovish, but he'll put warning signs, I think. He always tries to say that it's data dependent and the data suggests this, but if it changes, and he'll walk that tightrope. That's why he's been a good chairman, is that he really knows how to walk a tight wire that you go across. Yeah, not suggesting he does the Empire State Building or anything grand like what we saw years ago, but he always looks at both sides and he always mentions it. But we'll still get a sense if it's overall more dovish or overall dovish but neutral, or very dovish with concerns. So we'll have to see, and that will be the next impetus for where the metals go. If he starts suggesting continued rate cuts through the rest of the year, I would be hard set because inflation is at 3%. Typically, the Fed would not cut rates when they have an inflation level of 3%. Yeah. But I expect a rate cut. So there's a lot of nuances in what it takes for the Fed to make their decision. I think we're going to get an atypical decision, meaning a rate cut with high inflation. But we'll have to see what happens.
Yeah. Okay. All right. Before I let you go, I mean, we talked about the present. Let's finish by looking forward. I mean, the last time you were on Chart This was on October 14th, Gary, and you laid out those targets of $4,300 gold and a range of 55 to 58 for silver. Gold actually overshot your target just 6 days later before this reversal even happened. So, I mean, again, you're right. But this market, do you think that now that it's reset, are those price targets still viable within your original time frame of year end or early Q1? I mean, you talked about those, maybe a corrective, but if we see it go back here, I mean, what are your thoughts on 2026?
If the correction is hopefully more shallow than it could be, it's going to go to a primary third wave. It will take out the former targets I have, and that's where these new targets will come in. Because if this correction actually runs its course rather soon, meaning the next even end of the month, October's almost over, middle of November, it could easily go and challenge these new levels based upon the fact that it's in a primary first wave. And that, of course, would update my targets higher than they were originally. And the way I look at it is the targets we put out got hit. Then we got a correction. So it's exactly how we're seeing it play out, in that I didn't expect $1,000 rise in gold or the kind of rise in silver. But when that is what unfolded, I realized that in the case of both markets, whatever you want to do, even if the fundamentals want to move it higher, it's an overbought scenario and profit taking will come in. That was the primary impetus that took gold and silver lower, that broke everything. And so it was way, way overbought. I think we did 30% in 4 months. And it really went to levels that I was looking for in both gold and silver.
Yeah.
And we also believe that there's going to be a correction when it hit those numbers. And that actually came due. Now the question is, where will the correction conclude?
Yeah. Well, it's still a clear line in the sand for our viewers to watch, and you've been incredibly accurate. Gary, of course, your clarity in such a complex environment is invaluable. Thanks for making the time today.
Thank you for having me.
All right. That was Gary Wagner, the editor of thegoldforecast.com. Now, the key takeaways that the recent sharp sell-off must be viewed in the context of more than 50% year-to-date gain. And Gary is watching those key technical supports around $3,800 level as a potential floor for this correction, while more volatility is possible. His work suggests that the long-term bullish structure remains intact for now. Now, the immediate catalyst will be tomorrow's forward guidance from the Federal Reserve, which will set the tone for the remainder of the year. Of course, we're watching that right here at Kitco News. That's all the time we have for today. I'm Jeremy Szafron. Be sure to hit the subscribe button. Thanks for watching. We'll see you next time.